Welcome to This Week, Next Week, a podcast from GroupM. I'm Kate Scott Dawkins.
And I'm Jeff Foster.
Great. Well, we don't have Nidhi today. She's out for family reasons, but it's just us two to dissect the entire week's news, Jeff.
Yeah, and there's been a lot going on again this week. I don't know. There's something in the air the last few weeks, but
You keep saying that. No, it's never any different, Jeff. It's just always busy.
Yeah, exactly. So, yeah, there's always something to talk about.
Excellent. Well, I think we'll start with a little peek behind the curtains, what we get up to in the weeks in between when our listeners get to hear us, and then dig into some of the new data that came out this week. We're going to start talking, and when Nidhi comes back, we'll dig into it a little bit more. But for those who aren't familiar with our this year, next year forecasting, it is a look at the entire advertising industry, which channels are growing, which markets are growing fastest. And, coming up with that data is always a challenge, right? And there are things that we haven't covered historically or things that we've added recently. Retail media was something that we added into the report a couple of years ago based on how quickly that was growing. And so there are a couple of things. We always are looking at ways to expand what we do, but it can be tricky in terms of finding data. We've been talking about sport recently, right, Jeff?
Yeah, we have. And speaking of challenging data, that's definitely an area of that, especially when looking at certain aspects of the sports industry, like the sponsorship side of the business. There's, just unfortunately not great reliable data sets out there. A lot of the deals or details aren't disclosed. There's estimates floating around, but it's just can be very challenging just to find credible information.
But sponsorship is really interesting, right? I mean, we think about the ways in which reach is changing, in which people's consumption is changing, the increasing ways that people can skip ads or pay for non-ad supported services, whether that's music streaming or video streaming, something like a sponsorship of a team or a stadium. That's another thing that we would love to track, right? But doing it in a way that's consistent and good is tricky.
Exactly. It's just really difficult to find information on these deals. But as you mentioned, it's just, increasingly more important part of the industry as, trying to find those eyeballs is getting harder. As, these sponsorships have a lot of value in the marketplace, and especially in sports like soccer or the real football, depending on where you are in the world, that have limited commercial inventory. You're going to see, probably a high value of sponsorships that would really factor into the viewing time there.
That's exactly it. I was talking with someone in our German team last year and put up sort of a list of the top 100 programs in Germany. Last year, Germany hosted the Euros. So it was full of sports. But even beyond that, a lot of those are on free to air. The Olympics in the UK this year were on BBC. And so that, again, limits the number of chances you have to get in front of audiences. And so sponsorship is increasingly important, especially in places like Europe, where that tends to be the case more often.
Yeah, exactly. I think, here in the US, the sports are a little bit more tailor-made for TV with commercial breaks and stoppages in the game. But I think internationally, I think it might paint a little bit of a different picture.
Yeah. Yeah, we did watch rugby again last week, but it's an off week again this week. So I'll have to get my fix somewhere else. And then we'll spend time talking with Nidhi on influencers. She's looking at that particularly. That is so interesting. You get a lot of people coming out with size of the influencer market, but what does that mean? What should it include? When we look at our numbers, for the most part, we're looking at the distributors of content, the media owners like a media company like NBCU or a platform like Meta. And so we're already capturing any payment to those platforms, say like Meta or TikTok or anything else, for boosted or promoted or sponsored content. That's already captured within our digital numbers. So the question is, do we also need to, because of their growing role in the advertising world, need to capture what brands may be paying directly to these creators and influencers? Again, very tricky data sets.
Yeah, exactly. I mean, other than the IRS, I'm not really sure it's, these numbers are out there. So really hard to find. But I thought it was very interesting. Some in the news, I think Bloomberg reported how MrBeast is raising money and looking for a $5 billion valuation. So I think that just shows the value of the creator economy out there.
You think Skydance will try to buy him after swallowing the $8 billion Paramount deal?
I know it's crazy to think that we're in a world where MrBeast is not that far behind on valuation. I mean, it's incredible just to see what that world has turned into as far as
Yeah.
advertising goes and valuations.
Well, let's keep going. I spent too much time yesterday looking at the world of CPG. We still don't have all the companies in our composite in. We're waiting for reports from Henkel and Reckitt, for instance. I took an especially close look at the rest of our composite, excluding alcohol companies. So far in calendar year 24, excuse me, revenue totaled $640 billion, a 3.6% organic growth rate compared to 2023. So definitely slowing down from those sort of heady inflation boosted numbers from a couple of years ago. Are you noticing, are you buying more or less food or personal care, household care products?
Yeah, that's what I wonder if inflation is, factoring into consumer decision making here, after years of paying higher prices for everything. If you're cutting back, I know personally trying to be, more sensitive with the wallet and the share of spend, but perhaps that's affecting most consumers.
Yeah, I know advertising and promotional expense, for some they have different terms for it, and so you can't measure everything on an apples to apples basis. We tend to use median numbers where we can to correct for some of those outliers, but generally, advertising was roughly $68.5 billion for these companies that disclose it within our composite. And very excitingly, you know how I get about new data and data viz.
Yes.
We've gotten new data points recently from Unilever and Nestle. Now, these are not companies that historically reported an advertising expense within their annual reports, at least not as long as I've been doing this work within GroupM. But the advertising as a percent of revenue, I think, is such a common metric now amongst the analyst community and our analyses, and they've started disclosing it in some cases. And so now we actually have some figures for Unilever and Nestle in our composite. So for 2024, we have Unilever at about 9.4 billion euros for the year, and then Nestle at 7.4 billion Swiss francs. So we'll get those converted. But it is exciting to now have actual numbers. We can see where they rank, and they've given us growth over the last couple of years. So we have some historic data. But anytime we get more information from companies is always a good day.
Yeah, no, I agree. And I think it's going to be interesting. I mean, as consumers are probably getting, more choosy and picky about where their dollars are going, I wonder if you're going to see more of an advertising, increase in advertising to, really get back in front of consumers and be front of mind for a lot of the CPG companies. What do you think? You think we're going to see that?
I'm so glad you asked. Yeah, no, I think, and it may depend on which CPG is a big category. Obviously, we have personal care, household care, food and beverage. What we know historically, so advertising expense growth for this composite, the companies we have so far, was 7.5% in absolute terms. So actually faster than overall revenue growth, even in organic terms. But the median was just 3.3% for advertising expense growth. So quite a big spread between a group growing sort of double digits like P&G, Kimberly-Clark, Colgate, Coty, Kenvue, Clorox, and Unilever, and then a group growing around 2 to 3%, more in line with revenue for the composite, which was Coca-Cola, Pepsi, Mondelez, WK Kellogg, Dr. Pepper, General Mills, and Nestle. Did you notice anything about those two groups of names that I read?
Yes, some seem to be a little bit more focused on beverages, and some are not.
Yeah, so exactly. So personal and household care median growth for advertising was 10.6% in 2024. Food and beverage median was 2.6%. So a real sort of divergence between those two groups in terms of what we're seeing and who's really investing into the space. So it could be that we see that kind of a trend continue into 2025 as we're looking. I think, across the board, there's been a lot of discussion about, finding efficiencies, but also for the most part, where they can, reinvesting that into growing brands, focusing on their largest brands, right? Divesting some that aren't doing as well. So a lot of conversation about focus, efficiencies, but then really investing behind branding and marketing even in times of, I think, economic uncertainty. Now, some of these companies are going to be more and less impacted by tariffs and other things. So that could throw a bit of a spanner in the works.
Yeah. And, I think it might also be interesting to keep an eye on like the house brands for the major retailers too, to see if people are shifting a little bit more towards, the white label products, to see if that is, still capturing consumer dollars. Because I think, you always see a little bit of that going on in higher inflation times.
Yeah, no, it's super interesting. This is definitely a challenge that they talk about, recurrently, the CPG companies. And I think some of it is also dependent on how much they rely on either brick and mortar in total or certain brick and mortar companies, right? How much space do they have or negotiating power do they have to maintain shelf space versus white labeled products? I also found, and it's amazing when you spend time looking at a 10K, what kinds of information are in there. Again, really, showing my nerd creds today. One of the things that companies will report on is when they have a customer that is more than 10% typically of their revenue.
Yes.
The revenue concentration is something that investors want to know in case they ever were to lose a customer, right? Walmart is massive. It's a massive employer. It's a massive retailer globally. And it represents a huge percentage of sales for a lot of these companies. So Coty discloses that Walmart and all of its subsidiaries are 5% of total revenue. Colgate is 11%. A bunch are around sort of the 14 to 16% range, including P&G, Pepsi, Calanova, which is being acquired by Mars. And then you have a couple, Kraft Heinz and General Mills, around 21 to 22%.
Wow.
Walmart share. Any guesses for Clorox?
Oh, wow. Clorox. Man, I'm going to say it's definitely double digits. Am I mid double digits? Am I close?
A quarter, so 25%.
Oh, whoa, wow. Okay.
Yeah. Then the highest concentration I found anyway when I was just doing a quick cursory look, was J.M. Smucker at 33% for fiscal year 24.
Wow.
Yeah.
33% of the revenue coming from Walmart. Jeez.
Yeah. Which when you look at, again, Walmart then potentially asking for retail media dollars.
Right.
that's it just puts all of that, I think, into another level of perspective.
Yeah. No, the size of these markets is it's incredible.
Yeah. Now, Walmart has continuously said that they're seeing growth from the more affluent groups of their customers, which probably means or potentially means they're trading down from maybe more expensive stores to Walmart's. The CEO, Doug McMillon, said in an earnings call last year, high-income shoppers drove another strong quarter for Walmart. Households earning more than $100,000 made up 75% of our share gains, which over $100,000 is, definitely well above the poverty line, but still not the top 10%, say, of earners in the US. And there was a fascinating article from the Wall Street Journal this week. I know you read that as well. The top 10% of earners account for 49.7% of all US spending.
I know that number was just staggering me as a little bit of a history nerd, and just kind of knowing the history of the US economy built on the middle class, especially after World War II. Seeing that number was striking. I mean, it just shows you how much the economy has shifted, even though it's still heavily consumer spending focused. But going from the middle part of the the earning base to the top percent was just really shocking to see. It kind of confirms some suspicions that anecdotally that you see, but seeing the numbers, it was quite amazing.
Yeah, it's something we've been hearing from companies. I think both retailers and CPG, right? They're working on two sides of their business. They're working on premiumization, because there is a subset of customers that will continue to pay up, and they're working on value-based strategies for those lower socioeconomic groups. And the question is, how long can the economy maintain with that kind of spending from this group of consumers?
Yeah, exactly. I mean, you look at, it's just with especially with the rampant inflation over the last few years, like almost everything is a premium experience. Things that were traditionally very middle class, buying a car, taking your family to Disneyland, those were seen as sort of, an average middle class type of expenditure. Now those are all turning into premium experiences, and even going to fast food restaurants lately is turning into an expensive or a premium experience. So yeah, it's just, I mean, how long can consumers support that before you start seeing some cracks? That's always in the back of my head.
Exactly. Well, and it's one of the things that we have to consider for our forecast for the US as well, right? So right
Yeah.
now we're predicting 7% growth in the US on a nominal basis. Now, we've talked about, and I've certainly talked about with our clients when we're in meetings with them, how that may be impacted by geopolitical events, by tariffs,
Yeah.
by rising unemployment. If we have a large subset of federal employees who are all being laid off at the same time. But you start to wonder whether again, this top 10% of American earners, and that's households earning more than $250,000, according to the Wall Street Journal article, whether that group, if they're growing expenditures by 10%, right? Something like that.
Right.
If the top percentage of companies like the Microsofts and Googles and Metas and those tech companies are continuing to invest and grow investment, those AI infrastructure investments are growing, what, 20, 30, 40, 50, 60%. It's insane, right? So how much can these pockets of high growth sustain and, support an expectation for continued faster advertising growth?
Yeah, no, I think that's a great point. And also, I think when you look at sort of the market, kind of being flat or down, depending on which index you're looking at, I wonder if that weighs into the consumers that are making more than $250,000 a year, since a lot of them are heavily invested in the stock market. If they see their portfolios going down, is it something like, oh, we cut back on spending, maybe we're not going to buy a new car this year, maybe we cut back on vacations, going out to restaurants? So, it's, I think
that's
it's,
exactly
I think we're,
it. Yeah. If those asset prices start to come down. Yeah.
And depending on the housing market, I think when you have this much of your economy built on that type of consumer, there's some other things that can factor into decision making down the road. So it's all things to keep an eye on.
Yeah, asset prices, stocks, that definitely, if that hits a shock sort of crash or decline, then yeah, I think we see that pullback happen.
Yeah, because I think in the psyche for most people, you're okay spending, especially if you're making $250,000 more a year or more. You can probably wrap your head around spending 75 grand, 100 grand on an SUV. But if your portfolio is down 20% or 10%, that decision, may not be quite the same.
Yeah. All right. Well, let's move on to media companies, because we had both Paramount and Warner Brothers Discovery this week.
Yeah. So I guess we can start with Paramount. They went right before Warner Brothers did. So kind of listened in on the call. I don't know if you had a chance to listen in. It was kind of a muted call, I guess. I maybe it's just, obviously they did mention the Skydance deal is still on track to close in the first half of 2025. So that probably factored in. So we might only have another earnings call or so, this under the current management and ownership. But Q4 revenue was up about 5% to just under $8 billion. There is a Q4 streaming loss of about $286 million, which was an improvement from the $490 million from the prior year. So more of a continuing theme that we're seeing, and especially on the DTC side. So Paramount Plus subscribers came in at about 77.5 million, which was up about 5.6 million for the quarter.
That was a good quarter for them in terms of additions.
It was very strong. So some of the commentary around that was that the streaming losses are narrowing, and that they said that there's going to be domestic profitability for Paramount Plus is still forecast for 2025. So overall, heading into the new ownership structure, positive there. Filmed entertainment was about a little bit over $1 billion, so up 67%. Obviously, when you have movies like Gladiator 2 and Sonic the Hedgehog 3, that definitely helps.
Yep.
Unfortunately, I've seen neither, but I'm sure I will in the future.
Same.
Let's see. For content spend, they did mention they were going to be flat versus 2024 with a reallocation towards streaming and dual purpose. So my take is, expect to see more money spent on Paramount Plus, and that content then can also live on CBS or Paramount Network down the road. It was very interesting. Not a lot of talk about the cable networks on this call, but I think based on the state of the cable entertainment industry, that was probably to be expected.
Yeah.
And then looking at TV advertising, there was 4.98 million revenue, down 4% due to lower linear TV ad revenue and fewer sporting events, but that was offset by political advertising. So co-CEO Chris McCarthy said there was great growth in streaming advertising, and their direct-to-consumer advertising revenue was up approximately 18% for the year. They also touted their transformation from linear advertising to digital advertising. So management mentioned that Paramount has one of the largest addressable domestic footprints for digital advertising. So they called that one out.
Although, again, political helped. I mean, they specifically called out political for streaming as well, right? So this is definitely a new dynamic where streaming used to be the place in the 2-year-ago cycle and the 4-year-ago cycle where we might have counseled our clients and said, in a heavy political quarter, you want to move some money to streaming. Now that's no longer safe. It's everywhere.
Right. Exactly. And then they actually did talk about linear TV advertising, so they had some interesting points on there. Management again said that they singled out CBS being incredibly strong sports programming and a best-in-class primetime lineup. They did give an interesting data point: 7 of Paramount's top 10 hits and more than 50% of the top 25 overall helped insulated them from pressures from the linear landscape. So
I mean, I take all of that with you have to read earnings releases and transcripts with just a heavily cynical eye, right?
Yes,
like
exactly.
Most of this we just wash over and then we get to the things that are really important in the numbers. But yeah, okay, all right.
Yeah, exactly. It's interesting just to see how they're signaling to the marketplace, as before the changeover in management, and then they said cable advertising is now low double digits as a percentage of total ad revenue.
All right, so making that transition, that'll be numbers that we update again that we've been tracking for not just advertising revenue but total revenue. How quickly are media companies making this transition from a linear first world to a streaming first world? So we'll update that. We'll let them know where they fall in our rankings. They were not at the top of the pile as of the first 3 quarters of last year in that sense.
Yeah, exactly. And main emphasis was on digital, of course, during the call, again, as expected. And as we jump into Warner Brothers Discovery, a little bit of the similar going on there.
Yep,
so
and then we'll come back to content spend because I updated our content spend chart as well.
Yeah, no, that's always a good barometer. So for Warner Brothers Discovery, revenue was down 2% in the quarter to $10 billion. They had some interesting commentary on sports. I don't know if you caught it, that they did, prior to the earnings call, they did scrap plans for their paid sports tier on the Max app. So they snuck that announcement in before the earnings call, but on the call, they described, they talked about their pay TV declines, and they touted a tenuous and creative sports strategy in response.
Okay.
So, yeah. Okay. We'll see what that means. Obviously, they lost the NBA rights.
Yes.
So, that was an interesting deal that happened a little while ago.
Yeah.
For streaming, that was definitely a bright spot on the call. That Max will have at least 150 million users by 2026, and they expect the streaming business to deliver 1.3 billion of adjusted earnings in 2025, which would be nearly double the 677 million in 2024. So streaming, pretty strong, pretty solid there. For the quarter, streaming subs increased 6.4 million to 116.9 million. DTC revenue rose 5% to 2.7 billion, and the segment had a $409 million profit versus a $55 million loss in the prior quarter. And streaming ad revenue rose 27%. So very similar, we're no surprises there.
Yeah, I've been watching the Pit on Max, which
Yeah.
I'm really enjoying. So, although I only have one episode left before the season is done, so
So
see.
you are contributing to part of their streaming profit.
Yes, absolutely. That 27%. I mean, that's why it's a big number still, right? Even though the U.S. has the largest sort of streaming advertising markets globally, but that number is why we're still expecting even this year, or we're expecting 23.4% in the US this year for streaming advertising growth. So it's still pretty quickly chugging along there.
Yeah, definitely. And then they did talk a little bit about the network segment, which includes all of their linear cable channels. And it was interesting. They did acknowledge that U.S. linear TV the ad market has deteriorated faster than expected, which was making ad forecasting challenging. Which I think we can all relate to that.
Well, and these companies took those massive write-downs last year as well, right? And sort of acknowledging that, like, well, this isn't quite as valuable as we thought it
may
was.
have thought. Yeah, and then they did mention too that ad revenue dropped 17%, driven down by domestic networks, audience declines, and continuing softness in the domestic linear advertising market. So yeah, more similar commentary to what Paramount was saying.
Yeah, and that was, I mean, the whole year. It was minus, in constant currency terms, -11, -9, -13, and then that linear advertising constant currency number probably about 17.
Yeah.
So yeah. That is a rough year.
It was an interesting tone on the call because, obviously there's been a lot of speculation with the recent restructuring and, David Zaslav hinting at strategic opportunities. So we shall see.
Yeah. So content spend, because we did get both of their 10K, so we have that updated.
I did see that.
And we are looking at, we've done the rankings. I've pulled YouTube out just for now. But the rankings now including full year 24 or fiscal year 24, which for Disney is not on the calendar year. But top of the ranks goes to Comcast, then Disney, although it was a slight decline as we talked about previously in fiscal 24. Then Amazon, then Sony.
Okay, yeah.
And these are amortized costs, I should say.
Yeah.
So this is not the cash cost, but this is the amortized cost, which is what they give us in their 10K filings. And then, so Sony, Netflix, then Paramount, then Warner Brothers Discovery. And there is, say more than a $10 billion difference between Comcast at the top and Warner Brothers Discovery.
Wow.
And that final spot.
Yeah.
So that's a,
that's a big difference. That is a big difference. So, that's amazing. You see, and obviously Warner Brothers has quite a IP catalog too, which they did single out as, I forgot the exact quote, but they sort of, implied that they wanted to build out their IP rather than, rent audiences and the easy way by acquiring sports rights, which easier said than done.
I mean, also, I'm not sure, again, they're signaling to investors. They have the ways that they talk about things. But I think we've talked a lot about the importance of sports for building fandoms and communities and long lasting. I think if you look at the NBA show on TNT, you think you would absolutely say that that's IP and was IP and had long standing audiences that weren't being rented. So I take a little bit of an issue with that sort of characterization. But I think, Comcast especially has done well out of that to come up with the NBA rights, as has Amazon. And they're definitely putting the money behind those acquisitions.
Yep, exactly. And, they do have an amazing, Warner does have an amazing IP catalog. It's just, developing scripted shows on a big budget level is not cheap these days. And,
and more hit and miss.
Guaranteed to be a hit.
People are going to tune into sports every season. Mm-hmm. Probably they're going to watch their team, even if it's sort of an off, maybe not as many, but even if it's an off year for their team. But when we see something like, and sorry to pick on Warner Brothers, picking on Warner Brothers a bit here today, I'm sorry.
They're top of mind now.
But like Folie à Deux, which was a bit of a flop by most metrics, right? And so you have IP, but it can be a little bit more hit and miss than a standby like a league sports.
Exactly, and we can pick on Disney a little bit. I mean, some of the Star Wars and Marvel,
Sure.
decline has also shown that
Yes,
it's hard to keep up that consistency for years.
absolutely.
But when you look at the NFL, major sports ratings have been very consistent, growing and stable and growing for the last at least 5 or 6 years.
Yeah. All right. Well, on that, anything you're looking forward to this weekend?
Yeah, so we finally have a little bit of decent weather here in New York City, so that's exciting. But I will be continuing to watch Severance, which is fantastic. Highly recommend. And I will try to find some time to carve out to see the final episodes of Cobra Kai. I've made it this far, so I just, I got to finish out the series.
I tried to restart Severance and I felt so lost because it's been, I don't know, it feels like at least 2 years since the last season. I think we may have to go back and watch the entire first season again because
Yeah, it's very detail oriented. Like you got to pay attention.
Yeah. So I don't know if I'll get there this weekend. There's a lot going on. But eventually, it'll be fine.
Yep.
Excellent. Well, we will see you again, listeners, next week. This Week, Next Week is a production from GroupM, WPP's media investment arm. Content is for informational and entertainment purposes only and should not be considered financial advice.